Hey everybody, in this video we're going to walk through the exercises here for Chapter 7, Accounting for Receivables. As per usual, I'm going to let you all do the matching definitions work here on the first tab. But let's jump over to the second tab and work through some of the problems, some of the exercises. So here we can see we have a company, Your Co, that accepts MasterCard, Visa, and those companies will take a 3% fee when they send us the money and complete the transaction. So for example, the customer, swipes their card or scans it or taps it, when they make the purchase. And then MasterCard or Visa will handle the transaction in terms of the cash later getting in our account. But for doing that, they will charge us a 3% fee. And Visa and MasterCard receipts are deposited the same day they're charged, so quick deposit. Our company also offers its own credit card to customers, and our company charges 15% interest on unpaid balances after the first 30 days. Okay, so on 6/1, we performed $6,000 of services and we received payment via MasterCard. So again, we're receiving payment the same day. And so I guess let's start with our debit. And so in terms of us receiving payment, right, we're getting our cash right away. Since this was recorded essentially on the same day as we're paid, so there's not going to be a receivable that we're going to record because the cash was deposited promptly from, which one was this? MasterCard. So that, and the revenue that we earned was $6,000. You can see that here. But then the cash that we received is not the full $6,000, but rather, and we'll do a formula here. We'll take the 6,000 times 0.97 or 97%. So we're only getting 97% of the cash from the transaction, and then the other 3%. If we times the revenue by 3%, or we could just do the cash received minus the total service revenue. But that amount reflects the 3% that the credit card company is going to withhold related to this transaction for their service fee. And so for us as the business, we're going to call that credit card expense. And that's basically, just a service fee for allowing payments that way. And so that's the transactions as they look. On 6/2, we performed 12,000 of services for FCO and received payment via Visa. So same type of transaction. Both of the credit card companies are charging 3%. So we can just basically copy this accounting from above. We got cash same day. Again, Visa is going to charge us the same type of credit card expense. It was $12,000 in total. And then we can say we received, we were charged, 3% fee on this transaction. And then if we take the difference between those, that would be 97%. But we can just do that by taking the total minus the 3%, which gives us $11,640 in cash that we received. So we're not receiving the full amount of cash that we would if they had paid in cash, but instead we're having to pay a 3% service charge to the credit card company for them, processing the payment essentially. Okay, let's see here. On 6/5, we received $9,000 via MasterCard from G Company for work performed last month. So this was a slower payment, and in this instance, we're not receiving the cash immediately. I'm not exactly sure why that's the case necessarily, but there's some nuances here to what's going to transact here in terms of us receiving this and it being performed last month. So the fact that we performed this work last month, remember when we're getting to the end of any given month, we want to record that revenue in that month that we, finished the related services or sold the products and were owed the revenue. And remember and when we did that initial transaction, we would have recorded an accounts receivable debit. And now that we're actually receiving the cash later, and we can debit our cash because now we're being paid. Our accounts receivable is going down. So this is kind of familiar, just we've talked about cash and accounts receivable a lot so far in the class. But the difference again is that we have this credit card expense because the credit card processor basically is kind of acting as a middleman for us being paid our cash. So $9,000 of accounts receivable asset goes down, so we don't have any more accounts receivable. Again, 3% of the payment, and then if we want to do 97% of the total, that's the amount of cash that we actually end up collecting overall. So you can see these credit card expenses, they do add up for sure. And you'll know as a consumer, sometimes you'll go to shop somewhere and they'll say, oh, if you use a credit card, there's a 3% or 2% service fee. So they make the customer pay it a lot of the time. Okay, for this one, we performed $10,800 of services and received payment via Visa card. So again, this is just same type of transaction as these first two, where we are paid basically immediately. So we need to record the revenue in that instance. And again, remember, we would have recorded the related revenue back in the prior month, as it told us here. And it would have been a debit to accounts receivable, credit to revenue back in May in this transaction. That's why we don't have any revenue recorded, because we already did it last month there. But in this example, and let's work it from cash. So if it's 10,800 times 0.97, and then 10,800 times 0.03, and just add those together. So you can kind of do it that way, but it's the same amounts and accounting as we did with the first two. Okay, finally on 6.8, we performed services and charged, we used our credit card, our company's own credit card that we offer, and we are charging 15% on unpaid balances after the first 30 days. So again, 15% interest. That's not really going to come into play in this instance because the problem here says well, actually, I guess we don't know at this point. We're just charging their credit card, and so we haven't even received the cash yet. So we're going to book an accounts receivable and service revenue. There's no expense because this is our credit card that we're offering, and so that full balance of $4,800 is going to be recorded as revenue and as a receivable. No credit card expense related to this here because it's our own credit card, and we'd have to continue to watch this balance to see if it goes past 30 days, because if it does, then we would start accruing 15% interest on that unpaid balance until the customer pays us, essentially. So, but this is just the initial transaction of recording it, and you can see that there's no credit card expense, and cash hasn't yet been received. This is just kind of your run-of-the-mill accounts receivable type transaction. Cool. All right. Well, that's our tab 1. Let's move on to tab number 2. Okay, we're on to tab number 3. And in this tab, we are going to be recording bad debts and allowance for doubtful accounts transactions. And essentially what these are going to represent is as a company, if we have we have accounts receivable, so customers owing us money, some portion of that money that's owed to us is likely not to be paid just due to the customers going bankrupt, for example, or just failing to pay their debts, etc. And so we have a couple different methods for doing the accounting to estimate what those uncollectible amounts are going to be. Bad debts is what we're going to call those. Okay, so we have a couple different methodologies here. Let's start with question A. Says your company had sales of $50,000, an ending AR balance of $7,500, and a debit balance of $375 in the allowance account. Now remember that the allowance account is a contra asset, and that is a reduction to our accounts receivable balance. And whatever's in this, what's in the allowance account is intended to, like I said, be a contra asset to reduce that AR balance down for the amounts that we think will not be collected. Now, there's a couple different methods to do the accounting for the allowance account, etc. And this first entry, or this first method that we're going to look at here, is the percent of credit sales method. And this is more of an income statement approach. And so under that approach, we're going to record an adjusting entry if we deem, if we estimate that 1% of sales are going to be uncollectible. So if we think that 1% of sales are going to be uncollectible, we see our sales up here. We're going to record a bad debts expense. So it's an expense just like all other expenses that's going to be debited. And we're going to take our total sales and multiply that by 1%. That gives us $500. That's what our estimates put that at 1%. And we're going to credit our allowance for doubtful accounts, which is, again, a contra asset. And on the balance sheet, just like accumulated depreciation, how that reduces equipment and plant, property, and equipment type accounts, the allowance for doubtful accounts will reduce our receivables balance. Okay, so that's our initial entry using the sales method. And then here it says what entry is required if a company goes bankrupt next year owing our company or your company $100. So we've already recorded the expense associated with this potential reduction. And so we don't need to do more expense necessarily. We do need to write off the receivable. So we're going to credit the accounts receivable because we're not going to get that anymore. So usually when we credit a receivable, it's because we received the payment, and so we get rid of it. But in this instance, we're getting rid of the receivable because we don't think we're even going to collect it. And in order to adjust our allowance for doubtful accounts, we're going to debit that now for the same amount. And essentially what we did was increase our contra asset here by a total amount, and then we're decreasing the allowance here because that receivable that the contra asset was allowing for or was estimating would not be collectible, that portion of it is actually gone. And so we don't need to estimate an allowance on the receivable anymore because it's gone. We're not going to collect it. So we are going to reduce our contra asset to account for the fact that we now know that we're not going to collect that amount. So we reduce the allowance. So that is the method there. Okay, and so on question B, similar types of information here. We need to record the adjusting entry if 4% of AR is uncollectible. So this is the AR or aging method, percent of AR or aging, and this is more of a balance sheet approach where we're going to look more at the ending AR balance. And on the balance sheet approach, we're going to use the same accounts, so bad debts expense and allowance for doubtful accounts. But instead of looking at sales and multiplying that by a percent, we're going to look at the ending AR balance here. And I'm going to put it in parentheses. And I expect the red mark not to go away here at the first part. But we're going to take that ending balance times 4%. And it'll tell us kind of some information down here. So the thing is this is what we're estimating, 4% of ending AR to be uncollectible. But with the balance sheet method, we need to consider what the balance is in our allowance account before we record this entry. And so essentially what we want to do is have an ending credit balance in our allowance for doubtful accounts contra asset of 4% of 12,000 or 480. But in the information here, it says we currently have a debit balance of 120. So our allowance for doubtful accounts is not at zero. We want to get a credit balance up to 480, but it has a debit balance of 120. So if you want to think of it as negative and positive, we want to increase it to 480, but it's currently at a negative 120 is kind of one way to think about that. And so not only do we need to credit for the 480, but we also need to account for the 120 as well, so that we're shifting the balance of this account all the way from a debit of 120 to a credit of 480. And so that's the nuance of the AR aging method, is that you have to consider what is the balance in the allowance account and adjust your accrual by that amount. And sometimes it's a debit balance, sometimes it's a credit balance. So if it was a credit balance of 120, we would have needed less than 480 to end at a credit balance of 480, but it was at a debit balance of 120, so we needed more than the 480 to end at 480, right? So we're going to credit it for 600. 120 of that 600 is just going to clear out the current debit balance, and then the residual 480 will show up. We'll have an ending balance of 480 in the ending allowance account. And then again, same type of accounting. When we have an actual write-off, we're going to reduce our allowance. So we're reducing our contra asset and reducing the receivable because we're not going to collect that amount anymore. So once we know what accounts we're really not collecting, this is an estimate that we book regularly. And then this is us really knowing, hey, we're not going to get this amount. So we're actually writing off the receivables at that point and getting rid of the related allowance, because if this portion of the receivable is gone, we don't allow for it essentially or reserve against it. Okay, let's see here. C tells us we had sales, AR balance, and a credit balance of 273 in the allowance account. Record the adjusting entry of 3% of sales are uncollectible. So we're using the sales method in this instance. So it's that same accounting. Get comfortable with that. And in this instance, we're just going to take the 70,000 times 0.03. And we don't care about what the balance of the allowance account is because we're doing the sales method. We only care about that if we're doing the AR method. Okay, and then same kind of thing here. Allowance and receivables. And we just write that off. So every one of the write-offs is the same. That doesn't really change between methods. Okay, so we've now got sales of 60,000, AR balance of 9,000, and a credit balance in the allowance account of $45. And we're going to record the adjusting entry of 8% of AR is uncollectible. And so this is the AR method again. So same accounts, bad debts, and allowance for doubtful accounts. But this time, again, we're going to look at our AR balance, multiply that by the 8%. And again, I expect this not to be right. We're going to get an error that says, hey, you're missing something. But I just want to show you what we are intending the ending allowance account to end up at 720, a credit balance of 720 in the allowance account. But in this instance, it tells us we have a credit balance. So that's our target. We're ending at 720, but credit balance is what we want. But we currently have a credit balance of 45 already. So we're already 45, dollars of the way towards having a $720 credit balance. So we don't need to record that 45. So we back out and take off the 45, and we don't need to accrue the full balance because we already have a portion of a credit balance in the allowance account before we do our adjustment. Okay, and then we've just got our same process. Again, no difference. Reduce accounts receivable, reduce allowance for doubtful accounts, contra asset account, once you know that you're not going to collect on a certain amount. Okay, this one in E, it says sales, AR balance, and we're using the direct write-off method in this instance, and 1% of sales are uncollectible. So in this is kind of a trick question on our exercises here. We don't record an entry to accrue bad debts under the direct write-off method. With this method, which is not GAAP compliant, so typically you need to, if you're doing GAAP accounting, you need to use one of these allowance methods. But if we're using this direct write-off method, maybe if you're a smaller business who's okay having non-GAAP financials, we don't do anything as far as accruals. And basically we just wait until we know something's going bad. We're going to write off the receivable at that point and record a bad debts expense then. So the problem with doing it this way and why it's not GAAP compliant is because we are, we recorded the revenue of this receivable, whatever we're owed by this company in a prior period. and then we only record the expense later when we know it's not collectible. And those two events could be very far apart in time. And so that's why we do the estimation methods up here, because we want to try and estimate a certain portion of expense that we're going to need to record, and thereby better match this bad debts expense with the revenue that we're earning during that period. Because if we do it this way, we could have recorded the revenue a long time ago, and then we finally learned that there's a bankruptcy 5 years later or something, and then we would write this one off and record expense, 5 years later. So the revenue that we originally recorded and then the write-off and the expense would be in two completely separate periods. So that's why it's not really GAAP compliant, essentially. Okay, F says we got sales, AR, and a credit balance in the allowance account. But we're doing the sales method, so we don't care about the credit balance here. And instead, we're just going to use sales as our driver. Whoop. Shoot. There we go. So we're just going to take 95,000 times 0.01. And then same as we've been doing, we're going to debit allowance for doubtful accounts when we actually know something's not going to be received. Same as we did, through all the rest of the ones above. So one way I kind of think about it, if you're doing the AR method, you're targeting an ending balance in the allowance account, as a percent of 720 in this example, right? But when you're targeting that ending balance of 720, you have to take into account whether there's already a debit or a credit balance in the allowance account, and then you need to adjust your accrual so that when you do your journal entry to accrue a certain amount, then you end up at that target of the 8%. But it's not just the 8% that you need to transact, because you have to account for what's already in the allowance account. So whereas if you do the sales method, you don't care about that. You just account for it as part of, percent of sales, essentially, regardless of what type of balance is currently in the allowance for doubtful accounts account. All right, cool. Let's move on to tab number 4. Okay, now we're on to tab number 4 on our exercises. Sorry, I was just working through some of these, and let me delete those out and we'll work through them together. Okay, so we've got a whole bunch of transactions to record here on this one, so buckle in, because there's going to be quite a few things to record, but luckily they are going to be very consistent, and we can just follow the same process essentially. And once we get it down, it's not too hard, hopefully. And yeah, let's get started. So, excuse me, we're doing, so in these problems, we're talking about notes receivable. We are loaning money. A lot of times we talk about notes payable, where our business is borrowing money. But in this instance, we're going to be the lender, not the borrower. And so we have extra cash. We're going to loan that out. We're going to make some interest income on it. And yeah, that could be a good use of our extra cash. So cash is going out the door to start, right? Because we are loaning this money out. And typically, remember, we talk a lot about accounts receivable, but that's for, services performed and revenue that we're going to earn. When we're talking about loaning money, if in the context of owing money, we talk about a notes payable. But now that we're the lender, we're going to book a notes receivable. Asset account, all receivables, assets. And so cash of 35. Oh my gosh, I can't type. 35,000 goes out the door, and we record this note receivable, contract essentially to reflect the fact that whoever we lent this money to, H company, owes us $35,000 that we will be repaid in 90 days on this one. Okay, so now we get to the end of the year, and we haven't recorded any revenue yet. So again, we're going to want to book our revenue, and we're earning interest. Like we booked interest expense in the past, but now we're going to be recording interest revenue. So revenue is a credit, right? Just like anything else. Just like all other revenues, I should say. And we're going to book an interest receivable because we're earning interest from this borrower every day, at 6%. And so at the end of the year, at 12/31, they owe us a portion of money in revenue from having our money that long. And so there's a few things we need to do here to be able to calculate what this amount is. And let's just start out. I know this isn't going to clear our errors, but our marks here, but I just want to kind of do a few things with you here first. So first off, 35,000 times 0.06. So it's a 6% note. We're earning 6% interest rate. 35,000 is the principal. And so that would be $2,100. And that $2,100 represents the amount that you would receive in revenue for a full year. And we're assuming a 360-day convention. So if it was 360 days outstanding, the borrower, in this instance, H company, would owe you $2,100 extra in revenue, in interest. But we didn't have the amount outstanding for a full year. So we're going to divide by 360 first. So that's $5.83. And dividing by this, so this is a full year that we just looked at. Then we divide that full year amount by 360 to get a daily amount. And it tells you to use 360. Sometimes it'll tell you to use 365, but we're using 360 for a whole year. So we divide by 360 to get the daily amount, which is $5.83. And we need to know how many days this note has been outstanding. So it's been outstanding between 10/23 and 12/31. And that's the one thing with these problems that's kind of a little bit annoying, I guess. You can't, it's a little hard to do this, in any way on your fingers, or you can't do it on your calculator. You can do it, but you can do it on your phone. So what I do is I would just go and Google how many days between 10/23. Oh my gosh, I keep typing this in wrong, but I'm doing this into Google. It's actually, this is probably a good task for like an AI, like a chat GPT or something. So how many days between 10/23 and 12/31? 10/23, 21. I guess we need to put the year in there, and 12/31, 21. So it's, Google tells me, or I'm on Bing, I guess, is 69 days. So daily is 583, but we've got 69 days that we've had this money, loaned out. And so we have earned $402 of interest in that time of 69 days. Remember, if it was the full year, it would have been $2,100. We've just had 69 days, so that totals to $402.50. Oh, let me delete that out. So then we want to figure out, now it's at the maturity of the note, so 69 days elapsed here. And now at the maturity, we're talking about 90 days in full, right? So at the 90-day mark, so what is that? 21 more days after 12/31. So we could say January 21st of 2022 in this problem. So that's, getting us, and how I knew that was, we already recorded 69 days at 12/31, so we needed to add another 21. 69 plus 21 gets us to 90, and that's the full term of the note. And then we're going to collect our cash back. Well, let's wait to figure out what that is till we calculate the rest. Okay, so there's different components here. So notes receivable needs to go away. And this was the amount we initially loaned out. So now that they're repaying us, that note receivable needs to go to zero, and that's what we're doing by crediting the asset there to reduce it to zero. This interest receivable we had recorded previously needs to go away, and that's the $402.50. So that needs to go away as well. They're paying us all this money at once at the maturity of the note, 90 days later on January 21st of the next year. And finally, we need to record some additional interest revenue, because in the interim 21 days, there's been some additional revenue that we've earned that they had that outstanding, and we haven't recorded that part yet. So what I'm going to do, for that piece, I'm going to take this formula, paste it in, and we can use 21 days instead of the 69 days was here, but 21 days has now elapsed in January. And so when they pay us the cash, we need our debits and credits to match. They're paying us back the $35,000 we originally loaned them. they're paying us the $402.50 that was owed to us, at year end that we did a receivable for. And then we are going to be paid an additional $122.50 for the 21 days in January that they had the amount outstanding. So we loaned out $35,000 90 days ago, and we got paid $35,525. So we made $525 in those 90 days. So hopefully that's a good use of our money. Okay, so here we've got a similar problem. So I'm going to start going faster and faster through these as we go, because there are quite a few problems, and they generally all follow, very similar structure. So notes receivable, cash going down. This one was $55,000. It's an 8% 45-day note. Okay, so now we're going to accrue our interest at the end of the year. So we're going to do that same journal entry, basically, where we're recording a receivable and revenue. I'm actually going to copy this formula again, and we'll just continue to kind of use the basic formula because it's nice just to have it, but we need to update the principal. The rate is 8% instead of 6%. Same convention, 360 days. But now we need to figure out how many days is between 11/25 and 12/31. I might be able to do this one in my head, but let's just go to Google. So 36 days is what it tells me. So let's go with that. Yep, that works. So 440. So we've had the money loaned out for 36 days between 11/25 and 12/31. So that was 36 days. Now we're into January of 2022, and it's a 45-day note. So 45 minus 36 is 9, so January 9th. We got to put the year in to get that to go away. And yeah, now we're going to receive cash. Same kind of thing we just did before. And the receivable is going to go away. Our interest receivable that we booked at 12/31 is going to go away. And then we're going to have some additional interest. Revenue. Interest receivable one's real easy because we already booked that. It's 440. The principal piece is easy there because we know what that is, 55,000. So the only piece we really need to calculate is the additional interest revenue earned in January again. So we'll use that same formula, but instead of 36 days, we just have the 9 days in January that we are doing this. We are receiving revenue from, and then we just add those all together, and we get repaid $55,550 of cash. Loaned out $55,000, we got $550 extra back. 45 days later. So our money is working for us. Okay, very similar problem here. I'm gonna zoom out just a bit so we can sort of see both. And yeah, as we go, I'm going to kind of speed up on these because they're all very similar. This one's 20,000. And we're going to do interest receivable, interest revenue. And let's do I'm going to copy our formula again, but update the factors here. So we've got 9% now instead of 8. And how many days has this been outstanding? So 12 to 31. So what's 31? That'll be 19 days. Okay, so we get $95. And this is a how many day note? A 30-day note. So we have 19 of those 30 days already accounted for, and now we're going to have 11 days in the next month. Same stuff here. So very similar. And then let's just go back. So this is our principal portion. We're being repaid. Here's the receivable piece that we booked at 12/31 last year. Then let's again take this same formula and paste it here, same factors, but in this instance, we're only doing 11 days into January. And then we just add these all together and see how much cash we're getting paid. $20,150. Great. Okay. So at this point, let me just look through these, and if there's nothing significantly different to account for, I'll let you all just finish this out. But you use the same process, same accounts, same type of formulas, same type of logic. Yeah, similar stuff. Same 360-day convention. Yep, very similar. Yep, again, very similar. Just use Google if you need to get the amount of days between issuance of the note and the end of the year, and then, into the new year too if you need that. Same. Yep, same there. Yeah, all the same type of situation. So I'll kind of end the video here because you've got 3 examples that all use the same basic logic and accounting, more or less. You'll use all the same accounts through each one of these. You just have to update, the amounts and the accrual amounts in the formula. But yeah, if I were you, I would copy this formula down and paste that in as like I was doing above, just because it already has the structure built into it, and you just update the principal, the interest rate, and the amount of days that you're accounting for at the accrual period, and then later when you're paid. So yeah, good luck with that, and reach out if you have any questions on those, but I will leave it up to you to finish this tab. Okay, on to tab number 5, and in this problem we're going to be doing some accounting for when we are using factoring and essentially selling our receivables. And so what this factoring process is, when we factor receivables, like I just mentioned, we're selling them. We're selling the right to that money. So if a customer owes us, $90,000, or a batch of customers, a bunch of customers owe us $90,000, we might say, okay, we need the money now. We don't want to wait for the customers to pay us, and we're going to accept paying a 4% fee to get that money now, essentially, right? So we're getting the cash. We're getting rid of the receivable. It's no longer our receivable. It's going to be this company that we're selling it to, factor company. And then we are going to have to pay an expense, or a factoring fee. That's the 4%. So we're calling it factoring expense. And so $90,000 of receivables goes away. It's no longer our asset. It's factor company's asset now. So the customer's money will go to them. Factor company will get $90,000 eventually. They're kind of like a collection service, essentially. The 4%, we're going to be charged a 4% fee of that amount, and then the amount of the cash that we receive is the difference between the total receivable and the factoring expense that we had to incur. And then we receive $86,400 from factor company, and factor company is happy waiting, and they're going to collect the $90,000 later. So these are pretty easy to do, pretty quick. So I can just go through these here. So these are all going to have the same general overall process. So 72,000 here on mine of receivables. Same kind of thing. So they're all 4% fees. So I'm just going to copy this formula and paste it in. And then I'm even going to copy this formula and paste it in too. Very easy. Just like I mentioned, a way for us to get cash now, but with the downside of us incurring that 44% fee. And that fee might be different. These formulas that I'm pasting in here just takes into account 4%. It could be 10%, it could be whatever. You just have to multiply the full amount that you are selling by that factoring fee, and you're getting paid the difference. Then, debits and credits have to balance, obviously, still. Okay, that's number 5. All right, then we've got a whole bunch more allowance transactions to record. So let's kind of work through some of those. I'll do a few of these, and we've already done a bunch so far, so I won't, bore you with having a whole bunch of video for something that you're going to be really good at. And I want you to have your own practice doing this as well. So let's just go through a few of these though and practice some more. So we had sales, an AR balance, and we know we have a debit balance before recording any adjusting entries to the allowance for doubtful accounts. We have a debit balance of 162. And we are using the AR method, and so we care about the allowance account balance, a debit balance. We're going to end up at a credit balance, so whatever the 7% of AR comes out to be, we're going to have to add 162 on that to push it, basically from a debit balance to a 0 first, and then the additional 7% to end with that targeted amount, 7% of AR. So same accounts as we've been doing before, bad debts expense and allowance for doubtful accounts. And I don't think allowance for, allowance reported. The X will go away regardless of what you put in there. So just something generally making sense. I guess if you really wanted to do it consistent, you'd say accrue bad debts, and we would use the method there. So let's do that. Accrue bad debts and 7% of AR. So then again, like I just mentioned, we're going to take our $10,800 AR balance, multiply that by 7%, and then add 162 up on top of that in order to end us at a credit balance of the 7% plus the 10,800. And then we just debits and credits equal. That's our bad debts expense. And again, similar, if the entry is required, if they go bankrupt, that is where we're going to reduce our allowance for doubtful accounts with a debit. We're going to credit our AR for the actual amount. And then let me just look back and see, what did we say? We said, okay, so write-off account is what we're write-off account. Typically that's italicized, but we can't do the formatting in these, so whatever. Okay, so let's do one more of the AR ones, and then I'll do one of the sales, and then I'll probably just review the rest to make sure there's nothing weird, and call it good for the video on tab 6. So here we have sales, an AR balance of $4,400, and a credit balance of $88 in the allowance account. Remember, here we had a debit balance, so we had to add on to make that larger here. With this formula, we had to add on to it. Here, since we already have a credit balance and we're going to try to end at a certain credit balance amount, we're going to subtract, not add. So just to kind of make that easy, I'm going to take that formula, and here we can kind of, oh, I'm sorry, no, I'm wrong. This is a sales one. That's not an AR. I thought it was an AR. So, okay, I'll just do one of the sales. That's, and then we'll call it good. You've got lots of examples from that other tab, number 3. So in this one, we don't care about the balance in the allowance account because we're doing the sales method. So we will say accrue bad debts 3% of sales. And again, similar, we're going to do bad debts expense, and our allowance is going to be going up. And we're going to do 44,000 times 0.03, regardless of the credit, regardless of the balance in the current balance in the allowance account. We're just going to add that on top of, what's ever there, essentially. And this, entry will be just the same as this one with a different dollar amount. So I won't spend time there. So this is the sales method, the AR method, sales method, sales method, AR method, sales method, sales method. Yep. So they're all the same. You know, you just need to update the numbers and all that. So I'll let you all finish working on those. Okay, and here we've got some accounting for different notes and interest received or receivable. And so, yeah, let's work on this one here. I'll do a few of these. And so the only thing that's really different about what we did on the tab here is we use a 360-day convention for each one of the notes and the accounting we did. But in this instance, we're going to use a number of different ones. So let's take a look at that and do that first. Initially, the same accounting will, the accounting will be the same across. So we'll have our notes receivable going up and cash going down. They will owe us money, and but we're loaning the money, loaning it out. And so we need to know how many days are between. And maybe you're good at this. I just like to do it in Google I'm on Bing, I guess, just because it's, I don't know, hurts my brain to try and calculate dates. So 73 days. It's going to be the same type of accounting we did before: interest receivable, interest revenue. And I'm going to go back to tab 4. I'm going to copy that formula again because it's going to be very similar. Paste that in and just update the factors. So $36,000 principal. 7.3. So if you're going to do 7.3%, that's 0.073. Move decimal over 2 places for a percent. But instead of 360, we're going to use 365 now. And it's not 69 days, but Google tells me, or Bing tells me 73 days is the total. And it's a 90-day note. So once we've accounted for 73 days, we've got 17 days left to get to 90. So then we just do the same deal here: cash, notes receivable, interest receivable, and then some additional interest revenue from January, the 17 days there in January. I'll do that first. So I'll just copy that formula and do the additional 17 days there. This is the interest receivable we're going to get now when they pay us, and then the full amount of principal being repaid, and that will total us up there. Okay, so again, very similar. I wonder if I can just copy. I might just go. Oh yeah, that's nice. You guys might want to do that too if you want to go through. You can just copy and paste in these things here, and that will help us kind of get farther along. This one's going to be a little different because we're using the monthly convention, but okay. So yeah, let's read through it before we get too trigger happy there. So we loaned $48,000, 6% 5-year note, and we're going to record the entries at issuance, year end, and when the annual interest payment is received. And so we receive interest payments throughout the year, every year. So this is 1 year later, but the principal will still be outstanding and only be repaid at the end of the 5 years, basically, which is kind of good for us as long as they pay us after 5 years, because the more principal is outstanding, the more interest revenue that we earn. So let's take our formula again. Paste that in. And so we've got $48,000 in principal at 6%. But now we're going to divide by 12 because we're just doing monthly conventions, so we're not going to care about days at all. And doing this formula is going to be per month, but we're at the end of the year, and so we need to record April, May, June, July, August, September, October, November, December. So nine months. So times 9. So dividing by 12 gives us 1 month, and then multiplying 9 gives us the total interest revenue that we've earned between starting on April 1 all the way up into 12/31, 9 months. And then now in April of next year, we're gonna record the receipt of the principal payment, and so a portion of that principal payment is already accrued for here with this, and not interest. Oops, I meant to do interest receivable. So that's going to go away. So that'll be a portion of our payment, and then the other piece will be interest revenue. I'm going to take this formula again, and so we accrued 9 months at 12/31. And then we're collecting a full year's worth, so we already recorded 9. Now we're going to record the other 3. And the cash that we get paid is for that full year. Taking both those into account, they're going to pay us $2,880, and that's all principal, or all it's no principal, it's all interest, and we still have $48,000 outstanding, which will be paid back 5 years later. And so we'll continue to accrue interest revenue based on that outstanding amount. All right, so let's see here. I have a feeling this one's going to be real similar. And the only difference, so copying and pasting these in, yep. And then, this is a $60,000 note. So we need to figure out how many days are between 11/19 and 12/31. Search that, so that's 42 days. And I'm going to do this one because it's more similar to that type of formula. So 60,000 times the interest rate, which is what? 12%. We're using a 360-day convention now, as it tells us, so 360 instead of 365. And the difference is for the time outstanding is 42 days. Okay, so that's 42 days out of 60. So then in January, we're going to do, what is that? 18. So January 18th. And that's the rest of the 18 out of the total 60 days. And so again, I'm just going to copy this formula. So 42 days was the first part. Now we're doing the rest of the, out of 60 total, we're doing the rest of the 18. The interest receivable is just what we recorded at 12/31. The note receivable is the full principal amount. And then the cash that we get paid back is just going through and doing the whole entry there. Okay, let me look real quickly at the rest of these. So this is, similar to B, so you can kind of look back and analyze, the monthly convention. It's just interest being repaid. This is the 365 convention instead of 360. And 360, yeah. I'll do this one. This one's just a little bit different, it looks like, than the rest of how the rest of these are structured. So on this one, it says on 10/5, we loaned 42,000. So that's not going to be any different. Note receivable, cash gone out the door, 42,000 bucks. Okay, and then it's a 60-day note. No previous address. So we're just recording the full repayment basically. So there's no accrual that we're having to do in the interim at the end of the year. So 60 days after. So what, I think actually here's a way you can do this in Excel. 10-5-21. I'm just seeing, I'm not 100% this works, but 65 days or 60 days later. Did it work? No. Okay, whatever. I'm gonna Google that. So what is 10/5 plus 60? What date is 60 days after 10/5/2021? So December 4th. Yeah, that worked. And on an exam, I would tell you, how many days is in here. I wouldn't make you have to figure that out with a calendar or, I don't know, some other method. So don't worry about that for exams or quizzes or anything. So again, we're just missing this middle entry that we've been doing. We don't need it because it hasn't been the end of the year yet. That's why we did that accrual. And we're just having a full repayment then at December 4th. And we're going to record all the interest revenue at once. And then we're also going to get rid of our note receivable. So that goes to 0. We're doing a 360-day convention. So I'm just going to steal this formula, paste that in for my revenue, update our factors. So it's a 42,000 was lent at 9%. 360 convention, that's good. And this is the full 60 days that we are recording. That was here. So full 60 days. Jeez. Oh my gosh, this thing is really being weird. So that formula gives us $630 of interest revenue in total. And like it says in the problem, we just collect that all at once. And there's no need for an accrual entry to record interest receivable because we didn't go over a year end, basically. Typically, we would do this monthly, but this problem says, no previous adjusting entries were made or whatever. So that kind of guides us and tells us that we don't need to do that extra part. Okay, let's move on to the final tab here, tab 8. And in this tab, we're going to be looking, kind of just doing some ratios here, nothing too difficult, hopefully. We're going to look at gross margin and AR turnover ratio and profit margin. Okay, so net sales, remember, is going to be sales minus discounts minus returns and allowances. So 4,600 minus 35 minus 65, 4,265 minus 25 minus 90. Okay, and so that's net sales, and then gross margin is that number minus cost of goods sold. Okay, so that gets us to gross profit. And then net income, remember, is gross profit minus our other operating expenses and all the rest of the operating expenses. So 1,800, taxes, might be in there. And so that gets us to the bottom line. That's kind of the ending net income, essentially, right? Okay, and then average AR, and it's net AR. So 700 minus the allowance for doubtful accounts. So that's our contra asset. So 650, but we'll just leave it in a formula. So that's the first year. Then the year before that is 655 minus 55. Okay, so those are the two net AR amounts. And then I'm going to put another set of parentheses around those. So to get our average, we're just going to add the two net amounts and divide by 2. And then I'm going to copy this formula. And then we'll just update our numbers. This will be the same. I'll copy it and paste it over here so it kind of matches the overall structure of the other entry. So that's the current year. And then the year before it was 625 minus 25. So net AR would be that. And then the average, taking the two, add them together. You need parentheses to make sure that the order of operations works right, but you have enough parentheses and then divide by 2. That gives you a 2-year average. Okay, so gross margin ratio then, remember, is our gross profit divided by sales. So we can just do that. We're just linking up there. And so basically what we're saying is out of the sales that we have, what percentage was eaten up by our cost of goods sold, right? And then profit margin is similar, but we're going to not look at gross profit to begin with, but rather net income divided by sales. And that looks at what portion basically of your sales, what portion of your total sales is eaten up by both gross profit and other operating expenses. Okay. And then AR turnover ratio is net sales divided by average AR. So in other words, the turnover means how many times did AR go up and then down to zero, essentially. How many times have we fully collected all the outstanding AR that we've had? And the higher that number is, the better it shows our collections are. And collections are less, they're not outstanding as long, essentially. And one way to really show how long they're outstanding then is to do this formula for average collection period, where we take 365 for days in the year divided by the AR turnover ratio. Oh my gosh, what is the deal? So equals 365 divided by the AR turnover ratio. So we're saying in general, it takes us on average, that's funny how oh my gosh, okay, I'll just paste this in. Yeah, why is that so weird? Can't mess with the formatting, that's annoying too, because it's blocked out, but regardless, whatever. This is 45.63, this is 48.67 if you wanted to have it 2 decimal places. So we're saying it takes a little bit longer to collect for this company, or sorry, this year. And this current year, we're collecting quicker. So that's a good thing. We'd rather have collections as fast as they can be, right? We don't want amounts outstanding if we can avoid it. Okay, is your company's gross margin ratio better than the industry average of 45%? So our gross margin ratio here is, yeah, every year we've been above 45%, so that's good. Is your company's profit margin better than the average of 11%? No. So that's not great. We're below average. So it probably indicates that, because we're above on gross margin ratio, but not profit margin, that means that our operating expenses, which are added into the profit margin calculation, are higher than industry average. So something to look at there and try and find some efficiencies, look at other companies and try and figure out what they're doing different from you if you can. So, and finally, is the company's AR turnover ratio better than the industry average of 12? And again, no. We're at 8 and 7.5. And so the higher that number is, the quicker you are collecting. As you can tell, this number goes down the higher that this is. So if this was 12, we'd be collecting in 30.42 days. And that's what they're saying the industry average is. So we are worse than that. So it's taking us longer to collect than average. And so we might need to look to a competitor and poach one of their collections people or something, and they can help us design a better collection system, or maybe that's okay. Maybe we just operate that way in general, but it gives us some interesting information to be able to benchmark ourselves against others in our industry and see if we're doing better or worse in these areas. All right. Thanks everybody. Hopefully that was illuminating. And when you're going through, let me know if you have any questions. There's a few that are still open, but they all follow a real similar pattern as the ones we've already completed. So hopefully you'll be able to finish these out yourself. But if you run into any issues, as always, reach out to me. Ask a question in class. Doing it in class is even better because we can all talk about this together. If you have a question on something, somebody else probably does as well. But we'll practice quite a bit in addition to doing the exercises here. So thanks, y'all. Have a good evening and or day, or whatever time of day it is when you're doing this. It's evening here for me, and I will talk to you soon. Thanks, everybody.